Welcome back to Finance Professor. Today we're discussing the 5 C's of credit. That is 5 things that lenders look at when they're deciding if they should give you a loan. When evaluating if a bank should approve a loan, they typically look at 5 factors that give them a good idea on how likely that customer is going to be able to repay the loan in full. There are many more factors, but this is just a basic list so you understand how the banks are thinking when they're looking at loan applications. Let's jump in and look at the 5 C's. The first of the 5 C's is called character, and that's where lenders look at your reputation or financial trustworthiness. This is where lenders would look at your credit history on your credit report to see if you have a record of paying your debts on time. The second of them is capacity, and that's where lenders look at your ability to repay a loan. Lenders check your income and your employment history to make sure you're going to have enough money to cover all of your debts. Number 3 is capital. That's where lenders look at your savings, investments, or other assets that you might have. Lenders want to see that you have some skin in the game, I guess, that you're financially responsible, and it also shows if you're saving for emergencies and would be able to cover payments if ever there's an illness or you lose your job, something like that. Number 4 is for collateral. So for secured loans like a mortgage or a car loan, lenders require collateral, and that's something that you pledge as security for the loan, like a house or a car. That's something tangible that the bank can come back. If you default on the loan, they can take that and sell it to get their money back. That's why the bank holds the title to your car as long as you have a loan with them. Number 5 is conditions, and that's where lenders look at the loan's purpose and the broader economic environment. For example, if the loan is for starting a business, they're going to look at what the industry is like, what the trends are. Is that a declining thing? They're not going to want to give a loan for somebody making wagon wheels when automobiles are just starting out, something like that. Um, this is also what determines the interest rates. If there's a higher risk, there's going to be a higher interest rate associated with that. Together, these 5 C's give lenders a clearer picture of how risky or how safe it is to lend you money. They're going to look at these factors in relation to their own risk appetite, and they'll make a determination based on that. And we'll discuss risk appetite in another video. That should give you a basic understanding of the 5 C's of credit. Understanding the 5 C's can help you position yourself as a strong borrower and really set you up for success. Thanks for watching. I hope to see you in the next video. If you like, please like and subscribe. Have a great day.